And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. For the ETF community, Bitcoin is the gift that keeps on giving. Since the 10-spot Bitcoin ETFs first began trading in mid-January, flows have steadily increased. But can investors handle all this volatility? Let's talk with the managers of one of those Bitcoin ETFs. Matt Hogan is CIO of Bitwise Asset Management, runs the Bitwise Bitcoin ETF Trust, that's BITB. Also joining us, Simeon Hyman, global investment strategist at ProShares and manager of the ProShares Bitcoin Strategy ETF and the ProShares Short Bitcoin Strategy ETF, and Todd Sohn, ETF and technical strategist at Strategas Securities. All right, Matt, they've been trading these 9 new spot Bitcoin ETFs, including yours. I added it all up. Todd gave me the numbers. I see nearly 20 billion in inflows, including 1.3 billion into your ETFs. That's offset by Grayscale, which has had nearly 10 billion in outflows, but still, there's inflows. So just who's buying these ETFs? Is it a way to measure retail versus institutional? Do we get a sense of what's going on here?
It's hard, of course, Bob, to get a precise feel for retail versus institutional. But I can say at Bitwise, what we're seeing in BITB is a large number of types of investors allocating. We're definitely seeing retail investors allocating, self-directed individuals. But we have an increasing number of registered investment advisors who are allocating into our fund. We're having hedge funds allocating into our fund. BITB is being bought by venture capital funds and others. And I think we're going to see some other major unlocks in the future. So I can't give you percentages on retail versus professional. I know a lot of people wish we could, but of course in ETFs that's difficult. But we can tell you for sure that there are a significant number of professional investors buying millions and tens of millions of dollars of BITB, and I assume other ETFs as well. So it's both markets right now.
Todd, you're an ETF strategist. You do this professionally. Is there any way to measure this? I'm just curious, institutional versus retail?
It's a little bit challenging on the data front from my world, but the way I think of it is this is a access vehicle for institutions, right? Strategic allocations like Matt mentioned. And then when I look at retail, I say, okay, well, this is just another route for them to get access and availability to these Bitcoin. And I also take it in stride with what's going on within the equity market, right? You see leveraged ETFs starting to spike in volume, some of Simeon's products too along with that. And so in the near term sense, maybe retail getting a little bit offside, but I like this from the institutional strategic long-term portfolio case.
So Matt, just what kind of institutional acceptance or resistance are we seeing? I mean, the wirehouses, for example, is Merrill Lynch or Morgan Stanley or JP Morgan. Do they allow it on their trading platforms?
I think what we're seeing is different parts of the institutional community reacting with different levels of speed. So registered investment advisors, independent FAs, could buy it on day one, and they were buying it. Hedge funds could buy it on day one, and they were buying it. As you go up the chain to wirehouses or pensions or endowments, they have their own due diligence processes that takes weeks, months, sometimes quarters, sometimes even years. But I will say that from the day these launched to today, that process has moved faster than I expected. At first, people were saying it could take a year, then it could take half a year, then it could take a quarter, then it was a few months. And we keep getting calls every day. Can we talk today? Can we talk tomorrow? We have to accelerate this thing. So the wirehouses are still coming. Most advisors can't buy it on a solicited basis there, but they're going to turn on, I believe, soon. Eventually, everyone will be able to access these ETFs, and that'll be great for flows. I think it'll mean another uptick for flows in the future.
Simeon, you're the only one that's got a short Bitcoin product out there. Those of you who don't know, put up the Simeon Short Bitcoin ETF. When Bitcoin hit a new high last week, the short Bitcoin ETF, yours, hit a record in trading volume. That was interesting to me. And both the Bitcoin futures ETF and the short Bitcoin futures have had strong inflows this year. So your business, which is that futures business, it seems only to be strengthened by this.
To quote Mark Twain, the reports of our death have been quite exaggerated. BITO on the long side has prospered, $400 million of inflows this year. And we think it's a testament to the efficacy of the futures approach. Our premium to discount to NAV it's de minimis. And there's still a gap there in the spot folks that have launched. So a very important attribute there, strong flows. And of course, you mentioned the short side. So BITI seeing flows as well. And we're happy to be here, and we think we're serving as a key alternative.
And I'll ask you the same question I asked them, and I don't know if you have a better answer. Do you have a sense of who are owning these, or are these short-term ownership? Institutions, retail, what?
None of us really know. As best we can gather, we think there's a pretty broad range of folks out there. You know, it's funny, people have been talking about this rally and pointing to whatever they can to get their arms around it. Maybe it was the launch of the spot folks. But I always remind people that this rally started last year. I mean, this is the month of the anniversary of the collapse of the crypto-linked financial institutions. Last year, Bitcoin was going up then, too. So I think there are longer-term folks who are starting to come in for asset allocation and diversification purposes. But, of course, there's shorter-term folks, and we're happy to be on the long and the short side.
And, Matt, the halving, which we were talking about that's coming up in April, how much is that moving the price? I don't want to attribute this rise completely to all of a sudden Bitcoin ETFs. There are other things going on here, right? And there is a smaller and smaller number of these. You know, the amount available is getting smaller here. We're going to cap out at what, 21 million Bitcoin here, and we've got what, almost 19 million. You know, Matt, better than I do, already out.
That's right, north of 19 million. And as you mentioned, the halving is coming up in April. What the halving is when the amount of new Bitcoin produced each day falls in half. Right now, Bitcoin creates about 900 Bitcoin a day. And after April, it's only going to be about 450. A way for listeners to think about that is the total amount of new supply of Bitcoin coming into the market will shrink by about $10 billion a year starting in April. What's driving the Bitcoin market right now is a simple demand-supply imbalance. We have this huge new source of demand from these ETFs, and we have supply that's inelastic. And actually in April, that new supply is going to fall in half. That means, if these things stay the same, the price has to adjust upwards until we unlock some long-term holders who are willing to sell.
Well, this makes perfect sense on an economic theory point. We have inelastic supply and higher demand, duh. I mean, prices go up, right? I mean, it makes some sense, right? This is not insane. Like, what are these people's nuts? In a certain sense. But, Matt, I want to just ask you about the due diligence, because this intrigues me a lot. So you're sitting there. It's hard to get on Morgan Stanley's platform or JP Morgan. There is requirements, and among them, what you mentioned, this word due diligence. But one of the things I keep hearing when I talk to RIAs is this suitability concern. Gensler fired a shot at all of the investment community when he conceded they had lost on the Bitcoin debate, but said, may I remind everybody that under Reg Best Interest, Reg BI, you have suitability requirements. You can't give Bitcoin to grandma if it's not suitable for grandma to have Bitcoin. And he suddenly implied, not suddenly, subtly implied, that they could be open to lawsuits at all. I'm sure this is part of that suitability. Is the industry out trying to figure out what the legal standards are at this point for suitability? That seems to be a critical issue.
Well, the good news there, Bob, is that advisors have been doing this for years. Here at Bitwise, we've been serving financial advisors, helping them access Bitcoin and other crypto assets for more than 7 years. So there are well-established ways to solve that suitability question. As you mentioned, Bitcoin may not be for everyone. It's a very volatile asset. It moves around a lot. Some people find it difficult to understand. But for advisors who understand it, who study the market, who know their clients, who understand the risks and opportunities and can document that, then they can find a way to solve for that problem. Again, they've been doing it for years. But that's part and parcel of that due diligence. There's also due diligence on the funds themselves, on the custodians they use, on the liquidity ecosystem. But importantly, this is the same for every asset. It's just this is opening up a new asset class. And so we're having to do it. The good news is people are doing it quickly.
Todd, a lot of these new investors coming into Bitcoin through these ETFs may not be used to the kind of volatility. The stuff, we were 39,000 in January. What are we, 72,000 today? Is there any correlation, Bitcoin, with any other asset class? It's certainly not correlated with inflation, which is not an asset class, but is it correlated with technology? Is it correlated with nothing at all?
If I had to place it somewhere, it's high beta growth to me, right? These names that get going, especially if you get lower rates or a lower dollar rate, these risk-seeking assets. I don't know if it has a perfect correlation to tech specifically, but when I think of Bitcoin, I think of ARK.
Yeah.
Right? And ARK is high beta growth, non-profitable tech type
There is
stuff.
some loose correlation.
Yeah,
Isn't there?
maybe it'll come back.
I think that's sort of interesting, but I'm going back to last year because everybody's focused on the last 6 months. There was so much, up until the last quarter of last year, there was bad news everywhere. Not just the crypto bank demise, but also the FTX trial was in the news every day. And in the beginning of the year, interest rates were going up and Bitcoin was rallying. So I'm tempted to throw up my hands and say it's early days, we don't know. But the one thing we do know...
We don't know about the correlation.
We don't know about the correlation, but the one thing we do know is it's somewhat uncorrelated. And we know the math. If it's a volatile thing and it's sort of uncorrelated, you can sprinkle a little bit into traditional asset allocation and increase the efficiency of your portfolio.
Well, that's a good question about what you get when you add a new asset class. So, Matt, is this volatility going to dampen over time, or is it just all this silly speculation and we should not worry about it?
Yeah, volatility has actually come down substantially over the last 10 years, over the last 5 years, and over the last 3 years. I think as we add new types of investors into the Bitcoin economy, as we add sort of long-term investors, institutional investors, people who rebalance, who allocate every month or every year, that should serve to dampen the volatility. But it is still an early stage asset, right? We are early in Bitcoin's journey. That's great. It means it has a long way to run, right? It's still only 10% of the gold market. Many people think it could potentially be bigger in the future. It's going to be volatile, but yeah, I think it'll be a little bit less volatile than it was pre-ETF, and I think you may already be starting to see that emerge in the data a little bit.
So let me get to the subject you were sort of touching on just a moment ago. Simeon was mentioning, and that is what criteria should be used generally when adding a new investment class to your portfolio. What should it do? And I put up the full screen here because these are like the standard points people bring up about this. Should it make your portfolio more diversified if you add something? Should there be a lower correlation to other asset classes? Should it improve your risk-adjusted returns? Should it provide more liquidity? Should it provide lower volatility? These are like sort of standard things when you say, okay, I'm going to add Bitcoin to a stock, bond, cash, real estate portfolio. Does it do anything like that? Simeon, is there any? I hate to make you the Bitcoin advocate here, but is there any? This is this criteria you would use about why would I add this?
I think that's exactly right. And when you get back to this sort of prudence thing, it's about the asset allocation, not just about the asset. Of course, on a standalone basis, you've got a very volatile asset class. And there isn't anybody saying it should be 50% of your portfolio, but it doesn't take a lot when it's that volatile to increase that efficiency. And that's the right measure.
What is the right measure?
The increased efficiency of your overall portfolio. So in other words, the ability to create higher returns with a little bit lower volatility when you add it to a portfolio of stocks and bonds.
But does it lower volatility?
To the overall portfolio, because it's so uncorrelated.
Huh. Here's the problem I have with this. Tell me I'm wrong on this. This is how Wall Street drags you into this stuff. Bob, we're not saying it should be 50% of your portfolio, but it should be 1%. You've heard that argument? Oh, Bob, it's only 1%. So if it blows up, you only lose 1%. But think of it, if it doubles, now all of a sudden you have 2%. Then they'll argue you should have 5%. You see, so they drag, this is how it starts. Start a little and then get you more involved. Or am I just being paranoid?
No, I think that's correct in a way. I mean, listen, I think it gets overlooked that Treasury bonds, TLT, has the same volatility as S&P 500, right? And people are always vouching to put more bonds in a portfolio.
Yeah. Hey, Matt, let me just, I saw British regulators gave the nod to Bitcoin ETFs for the first time. Can you just talk about that for a minute in global trading and where we're at? We're just talking exclusively U.S. here, but maybe you could tell us a little bit more about global.
Yeah, absolutely. We've had Bitcoin ETFs in other jurisdictions for a while now, in Sweden, in Germany, in Brazil, in Canada. And as you mentioned this morning, we learned that the FCA in London will allow Bitcoin collateralized ETNs, which are ETPs that provide exposure to Bitcoin. That's a big breakthrough. The UK has been behind the curve. And I won't say that the US moving forward and the huge success we've had here pushed them forward. But one thing that regulators should see anywhere around the world is that when ETFs get involved in a new asset class like Bitcoin, costs come down, security goes up, and investors have a better experience than they did before those existed, I think we're going to see Bitcoin ETPs, Ethereum ETPs, and eventually other crypto asset ETPs in every jurisdiction around the world. It's part of the normalization of this asset class, and it's strictly a win for investors. You know, here in the US, we lowered fees for Bitcoin products by about 90% from pre-ETF to post-ETF. It's great to see the UK following suit, and that's good for this asset class.
Yeah, I completely agree with you. I've been neutral on Bitcoin for many, many years. Big backer of blockchain, big backer of smart contracts and Ethereum, neutral on Bitcoin, but a big backer of Bitcoin ETFs for exactly what you said. For those who want to own it, it's a far safer way for owning it.